You kind of touched on some of these here, but yeah, the first one is just an overview of why this is happening in the market today. And two is, should people be worried? Like, not so much, or I guess you can give your thoughts here, like long-term and short-term. Like, what's kind of your outlook for stocks going forward? Should people be calling their 401k advisor and telling them to cash out? Like, how should people be feeling now?
Well, I think that money is a very emotional subject, right? Because our brains are hardwired, I should say, to keep us safe. And so it's our brains spot danger, and it will see danger, process danger much more alertly than it will a good time, right? So when we see markets selling off like they have been over the past couple of weeks, those flashers go off, right? This is my money. I'm concerned about this, and they should be, right? These are retirement accounts. These are in many ways lifelong works savings that have been in place. But I think we need to go back to our time horizon. Over time, the stock market, which we're going to talk mostly about right now because that's what's in the media right now, the stock market goes up and to the right. And it has its periods of time when it goes through its volatility and it finds its natural level. And volatility can be caused by a couple of different reasons. What we look for is market risk, or do we look at systemic risk? So what's the difference there? Market risk is the natural rise and falls of the US stock market. So when we sit down in our January planning meetings, we anticipate the market to have a decline of at least 10% once or twice during the course of that period of time. That's called a correction. And that is normal. That decline of 10%. So right now I mentioned the S&P 500 is down roughly 10%. That's normal. We should experience that, or we should expect that several times within the course of a year. That's natural market movement. That is not systemic risk. Systemic risk is there's something broken in the underlying economy. So systemic risk would be 2008, the housing market crash, the subprime loans that were out there. That was a systemic risk, and that caused a deep, deep recession. I don't believe right now what we're at is anything systemic. We're seeing the market try to figure out what level it should be at based on what interest rates are going to do over the next 12 months. And the problem it's having is it's unknown. They don't know how many interest rate hikes they're going to have. So to answer your question, Derek, or the question that was asked to you, should you be concerned? We're always concerned about our money. Am I concerned about our portfolios? No, I think what we're seeing is natural market fluctuation, and it's nothing to be alarmed about.
Yeah. I think another good point you made right there is like just the comparison of what's happening now in 2008. Like, I think these are drastically different circumstances. Yeah, I don't think there's any systemic risk, like inflation. People should, or maybe investors should be worried about inflation because the Federal Reserve might be more prone to raise interest rates in the near term. But I think demand is so strong in the economy. Like, we're coming out of COVID, and like the balance sheets, like some of these companies that we're watching, like they're such on solid ground. I don't think monetary policy is going to change that one way or the other. It might change outlook for like GDP growth, like macroeconomy stuff. But I know we keep using NVIDIA as an example, but they literally can't keep their chips on the shelves. Like every chip that's coming up, and the AMD, the Advanced Micro Devices CEO said the same thing. Like every chip that comes off the assembly line or however they make them, it has a buyer already. Like they literally can't keep these things.
Yeah. Think about the years prior to this. So we were in a period of historically low interest rates for such a long period of time. And now we're at the point in time where that environment's going to change. So the environment's going to change. What the stock market likes is known. Good or bad, it likes the idea of knowing what's coming ahead because then it can plan for it and companies can plan for it. So I think what we're going to see until the interest rates happen is it's pricing in worst case scenario. It's pricing in many more hikes than what may actually happen. And until we have some sort of a known period, we're going to see some volatility. Again, I believe the market is oversold. That doesn't mean it's going to turn around today. It just means that I think that there is some real value out there if you're a long-term investor. And what I mean by long-term investor, we've got a time horizon of 2, 3, 4 years down the road.
Sure. And I think like if you look historically, like rate hikes are in the news, but I can't see it. I can't imagine a scenario where the Federal Reserve comes out and raises rates to where they even have been historically. I think money is still going to be cheap, relatively speaking, compared to, because I mean, if you look at inflation in the 1970s, early 1980s, what the Federal Reserve had to do to stamp out that inflation was like raise interest rates over 10%. We're not in a scenario where that's feasible. Like you would, like the Federal Reserve is too market conscious. Like they care too much about stocks. They care too much about like just the economy as a whole. They're not going to voluntarily bring us into recession if they didn't have to. So I
Yeah.
don't think we're in that situation. I think money will remain relatively cheap.
I agree. The thing that that is interesting is that I would agree that the Federal Reserve does pay attention to the market, right? And historically, that's not its job. Its job is to
Right.
maximum sustainable employment and to have price stability there. And now that it's paying attention to the stock market, you could argue that's good or bad. But in recent history, the Federal Reserve has been a backstop for the market.
Sure.
So what we're seeing now, I guess the point of what I wanted to do that put this out there is it's been some time here since we've had a market correction. These historically are normal. And again, I would expect them several times a year. I would expect swings of 10% several times a year. Normal stuff. What we look for is there's something underlying to be concerned about. And as I view it right now, the thing that I see in the market is it's trying to find a level that it should be on based on the interest rates that are coming in the future. Apologize, guys.
Bro.
Coming in the future here. And the fact that it just doesn't know that yet is why we're seeing a little bit of sell-off. It's pricing in worst case scenario.